I'd like to review a couple of housekeeping items. First, this is a listen-only webcast, so please, if your video is on, make sure that's off, and make sure that you are also muted. There is a chat button at the bottom of your screen where you can submit questions anytime that you have any questions. We will try to get to as many questions as possible during this hour. However, following the webcast, we will be publishing a recording of this webinar, the slides, and a Q&A to our website. You will receive an email with a link to our website once everything is available. Welcome to the Baldwin CPAs webcast, Understanding Available COVID-19 Relief Options for Businesses. The Families First Coronavirus Response Act and the Coronavirus Aid, Relief, and Economic Security Act allocated billions of dollars to help businesses and nonprofit organizations keep workers employed amid the COVID-19 pandemic and economic downturn. Both of these acts have given employers multiple avenues of supporting their operations and cash flows. The Baldwin CPAs team has studied the acts in detail and will walk you through the various options available and the corresponding eligibility and compliance requirements. Our presenters today are Baldwin member Lisa Foley, CPA, CGMA, and accountant Matthew McCurry. And at this time, I'll go ahead and move it over to them.
Thank you, Leslie, for getting us started today. We're glad to have everyone with us. As if some of you signed up a little early, you'll notice that the title did change and the subject a little bit. We have never been in a more fluid time frame for dealing with things like this. Accountants, CPA firms, Baldwin, we are used to April 20th being able to take a deep breath, and that has not been the case this year. We didn't get to work on a lot of tax returns over the last couple of weeks because helping our small business clients navigate through all the options has been really important. But our original webcast was scheduled to be strictly about the PPP program, but the funds ran out of that late last week. So we kind of wanted to cover the other options that are available, but we'll also talk about the PPP program because I think the Senate is pretty close to a deal of an additional $370 billion. 250 would be for the PPP program outright, and then an additional $60 billion allocated just for rural and minority groups. So we have not seen the definition of what that rural and minority group will look like. As soon as we know something, we'll get that posted out on our social media. But they're also going to add another $60 billion to the EIDL disaster loans. So we'll talk a little bit about that today, but just it is a very fluid situation. And if you did not get in on the first wave of the PPP program, I would just encourage you to reach out to us, reach out to your CPA, and have that application ready, because I really feel like the money will go extremely fast this time. I know Chase Bank has said they have 25 to 30 billion applications ready to go. They didn't get filed very quickly. Chase was really slow getting their system up. So we'll talk a little bit about banking and the choices on the PPP program as well. But we're going to highlight some of the other things that are available. If the PPP is out of play, there are still definitely some other tax items that you can take advantage of and help your business with cash flow. So that is a little bit of an overview, and we'll also cover a little bit of the PPP forgiveness program, how that's going to work. So those of you that have been fortunate enough to get in on that program already, you'll get an overview of that. And I think we are going to just kind of watch our social media. We do plan to do a full hour webinar on forgiveness later this week because I know that's going to be it's a real hot topic with a lot of our clients. So kind of an overview of where we're at and what we want to look at. But I think we'll go ahead and move in. And again, as Leslie mentioned, feel free to ask questions, and we'll try to get to as many of those at the end today as we can. So, appreciate the chambers having us do this. We've done it a couple other times, different formats, and it's been very beneficial. So we will get started. So the first act that came out that offered some tax relief was known as the Families First Corona Response Act. And that really offered up two different types of payroll tax credits that employers are going to be allowed have available to them. So the first type that was presented in that act was a 2-week paid sick leave. And just so you understand, there are some hoops that employees have to jump through. Our HR team has done a great job of preparing those forms that you need to get signed and keep in your HR file. So at the end of this, if this is something you're interested in, please just reach out to us because we've got a lot of that developed and we're happy to help with that. But to qualify for the 2-week paid sick leave, the employee has to be under a local, federal, or state quarantine or isolation order related to COVID-19. Or the employee has been advised by a healthcare provider that they need to self-quarantine, or they are experiencing symptoms and they're seeking a diagnosis. Those are the first 3 hurdles that have to be proven to qualify for the 2-week paid leave. There are 3 other options as well. If the employee is caring for an individual that's under the order and the person they're caring for is under an isolation order, or if they're caring for a child that their school is closed, which I know we've all had a lot of that, or there's a little caveat of experiencing any other similar condition that the U.S. Health Department has put out. So those are the things that employees are required to prove to be able to qualify for that. And so as employers, you've got to do a really good job of documenting that. So I think we had a lot of clients that were really concerned that people were going to take advantage of the situation and do that. And to be honest, that has been very limited. So I think that has been kind of a bright spot. But, one of the things you have to think about, if the employee is able to telework, then this is off the table. If you can provide them the ability to work from home, then they do not qualify for this. And then on top of that, if the 2-week paid sick leave, that, you get through that period and still schools and daycares are shut down. And there's also a 10-week paid family and medical leave. And we'll talk a little bit about how those credits work. But the 2-week paid sick leave, moving back up to that one, is your employees would receive 100% of their pay if they are in that first 3 options we talked about. So they're quarantined, self-quarantined by a healthcare provider, or they have symptoms. So they get 100% a day for that. And then if you fall into that, you're caring for someone, taking care of a child, those last 3 exceptions, the pay is only 2/3 of the regular pay is how the dollars of that work. And what happens is, this is for the time frame April 1st through the end of the year as they have it right now. And you receive 100% refundable payroll tax credit for those wages paid. And it also includes your match on Medicare because you're not subject, because they are not working, you're not subject to withhold Social Security for them. So that's a little bit of a difference, but this really is for all employers that have under 500 employees. And you say, oh, normally small employers don't have to follow FMLA, but that's really not true. There are some special exclusions in this case if you're under 50, but you've got to meet some very stringent deadlines, some caveats. So, definitely reach out to an HR professional and check on that, because just because you think you're under 50 and this doesn't apply, that you're required to do that is not necessarily the case. There are really some strict guidelines that you have to be able to prove to show that you're not required to make this payment. But again, 100% refundable payroll tax credit of the wages paid. So that covers that screen. So then those were the first credits available. And what I will say, the credits I mentioned just are refundable. And we'll talk a little bit about how the retention credit is also refundable. So I'll kind of talk about the mechanism of how that works. So the second act that was passed is the CARES Act. And that brought about the retention credit for employers, the ability to do a payroll tax deferral, and the CARES Act is what established the SBA Paycheck Protection Program, which has been very, very popular as we've discussed. So let's move into the retention credit. The retention credit is, again, it's a refundable payroll tax credit. If you continue to keep people employed, you get a credit of 50% up to their first $10,000 in wages, including their health care cost. You get a credit. So basically, if you up to $10,000 in wages, you're going to get a $5,000 credit per employee that you keep employed in the period of March 12th through the end of the year. So this is for all employers. If you have more than 100 employees, you can only do this for wages of your furloughed or reduced hour employees. So you've got a little bigger hurdle to jump over, and they've limited it once you get over 100, but it is available. So one of the big items that a lot of people have heard, if you get the PPP, then you cannot take this credit. So it really kind of is a one or the other, but what I will say, there has been guidance put out that says that if you notice here, the screen says that if you're ineligible if you're receiving PPP loan forgiveness. So there are FAQs and guidance out there that has brought about the fact that you can take the retention credit up until the point that you are given loan forgiveness from the lender institution of your PPP loan. So we've had a lot of clients that got funded last week, and we're going to go into a little bit, but that starts your 8-week period. At the end of the 8 weeks, you have, I believe, 90 days from your original loan funding to apply for the forgiveness. And then I think the bank has to turn that around in 45 to 60 days. So there is a time frame of maybe 150 days that you could take the retention credit until your loan is forgiven. So just kind of keep that in mind. We can probably go back and figure some retention credit, because the first guidance that came out, it was one or the other, but they have clarified that you can take this retention credit up until the point of loan forgiveness. So you can double dip a little bit for a short duration of time there, to keep that in mind. What I would recommend, it's what we've been doing from a payroll standpoint, is you really have to develop some separate pay items or pay codes in your payroll to track these different pay items so that you're monitoring your credits effectively. It's been a hard road for the payroll world as well to monitor and track this to make sure that the employers are getting the best credits and getting all the money and relief that they're eligible for. So like I mentioned on the first two credits from the FFRCA Act, this credit can be refundable. So the credit is allowed to just reduce your 941 deposits, but you could get to a point where it reduces it. You've got more credit than you have taxes that you're paying. So there is a form 7200 that's available to file and get an advance payment on that if you need it quicker than the quarterly filing. They are changing the 941 form for the second quarter of 2020, which will have a place for the credit. And if you have an overpayment, it will refund off of that. But the main goal of all these acts is to keep money in the economy and cash flow in small businesses So they have opened up the 7200 form to help you get money back, because there really was no way to take the credit on the first quarter. They said, okay, take it on the second. So I believe this form 7200 will be really important if you are paying people in that March 12th to the end of March area. You might want to look at filing the 7200 and getting that money back in the hands of your business now. All right. After the retention credit, we talked a little bit about payroll tax deferral. This is one that a lot of clients have asked about, and you basically, you can defer the payment of the employer's share of the Social Security tax. So the 6.2% employer match can be deferred. It does not have to be paid now, and there will be no penalties or interest on doing that. So it applies to wages that were paid on March 27th forward to the end of the year. And the repayment of those, 50% of the amount you deferred will be due at the end of 21, and the remaining amount will be due at the end of 22. Again, same rules that if you are ineligible to receive it once you receive your PPP loan forgiveness. So just kind of keep that in mind. I have a client that's doing this. They got a large PPP loan, but we figured out that even if they can do this deferral until the forgiveness determination comes back, it's probably going to save them $150,000 in cash flow right now. And so they are a business that has really been forced to very limited activity. So that $150,000 will be helpful for now, and they just know that they've got to, strategize and figure out a way to pay it back at the end of 21 and 22. So the other thing you have to say, you have to apply the retention credit first. So if you are taking the retention credit on wages and reducing your federal deposits because of that, that has to be applied first, and you can only defer the remaining portion after you apply the retention credit. And that is pretty much all on the payroll tax deferral. A lot of clients have seen that as a good way to get some instant cash flow. So the CARES Act, as we mentioned, that's what created the PPP loans. Now, this is an SBA loan, a 7A loan, which has been around a long time. They just kind of tweaked it to fit the need of this act. The first wave of this, there was $359 billion available. It's all been used up at this point. But the mechanics of the PPP loan is that the funds can be used for payroll cost, rent, utilities, and interest on mortgages between the time frame of February 15th, if you got funded that early, or June 30th. So, and I guess what I would say is it's 75% of it has to be used for the payroll side, and only 25% of the money can be used for rent, utilities, and interest. So that's kind of an important determination, because the calculation is you go back and you figure your 2019 average monthly payroll, you take that by 2.5 times, and that's the amount of your PPP loan. So by formula, you've got to turn around and spend that money in 8 weeks. So obviously that's only 2 months of payroll. So the mechanics of that formula basically say that leaves you 25% to use for other things. There are a lot of FAQs out there. There have been a lot of good questions of what all does utilities include. Right now we've seen electric, water, gas, sewer, telephone, which has brought up the question of cell phones. That we've been on a lot of webinars that feel like, cell phones have replaced regular phone lines. So we feel comfortable taking that. I assume we'll get more guidance. But there's also been even questions out there about gas in a construction company for running vehicles and things, and there's just a lot of questions out there. And we just hope for more and more guidance as the weeks go on. But we are working on a spreadsheet. We've really got it ready that we're going to roll out this week to help clients track the cost, because it is a tricky calculation because, and Matt's going to go into that here in a few minutes, you know, yes, you have to spend 75% and you have to spend on payroll and 25% on these other items. That's the first hurdle. But there are also hurdles of keeping your FTEs up. And you have to meet those requirements as well to qualify for the forgiveness. So this is available to all businesses that are under 500 employees. There is a caveat that it's basically not available to like financial institutions or even financing companies. We had that come up with a couple clients that have, you know, just small financing for furniture and equipment. They are carved out that they cannot apply for this. So under 500 employees, or if your industry has a different SBA size, and that would just be to help you. For instance, the oil and gas industry has a 1,250 employee limit to be SBA. So they can have 1,250 employees and still qualify for this loan. The last blurb there on that bullet point, I think everybody, if you've been watching the news this weekend, this is what has caused the stir, because there are exceptions for NACSIS Code 72s, which is restaurants and accommodations. So they carved out, obviously restaurants have been very hard hit in this pandemic, and they have carved out the ability for restaurants, if, you know, lots of times a franchisee will own 5 or 6 different locations. So if they had to pool all those together, they would be over the 500 employee size limit. So what they did in the act is said, okay, if you're in these industries that start with a 72 in your NACSIS code, you are allowed to count your employees by location. And as long as you're not over 500 in any location, it will not throw you out from getting the benefit of the PPP program. Problem with that is it's been plastered all over the news this weekend, and I saw that Ruth Chris has told everybody they've got $20 million of this loan. And, you know, it's a very high-end steakhouse, which is leaving a bad taste in everybody's mouth, which I think will help propel this money passing early this week. But that's been quite a situation that people have not been very happy about. It's put people at a disadvantage. And I guess what I would also say is put it as a disadvantage, as I alluded to earlier, the big banks that tried to make the process completely online and electronic, it took them a while to get their system built. And then once the system was built and they got online, the funds were essentially gone really quick. We really focused, so we have some clients, I mean, we have a client that was eligible for $1 million that was with a big bank that did not get the money because their bank didn't get their side done in time. So that has been a real struggle. We really focused and partnered with local banks, and that helped. And honestly, I think most of the people that we did applications for got them processed and got them back. We have a few stragglers that we're hoping to get in this week, but you know your banking relationship. If you have a good relationship with your banker, stay there, use them. A lot of banks have said we're only doing our customers. We're not going to open it up. We've had a few banks that have worked with us to process some non-customers, but they did make them start a checking account and different things. But your banking relationship at this point is really important. And I think the big banks, now that their systems are up, you know, I think that money is going to go really quick. Like I said, Chase had an article that they had 25 to 30 billion sitting there in their queue ready to go out before they ran out of money. So I think you have to be very proactive and really work those relationships with your banks to try to get yourself in line. Some other benefits of the loan: it is 100% federally guaranteed. Once you sign off on all the certifications, the loan at the bank is really not at risk. The government is backing that up to the bank. And again, 100% forgiveness is possible, but you're going to have to jump through some hoops. If you don't reach that 100% forgiveness amount, what you need to know is it's a 2-year loan with a 1% interest rate. So we've kind of advised our clients that, okay, let's say we can only get 80% of it forgiven. We'll pay the other 20% back. And if you can afford to do it early, fine. If not, you've got that 1% interest rate that you're going to have to pay for 2 years to pay it back. And I think it does amortize monthly on the payout. So, a lot of people's like, oh, I don't want to go in debt. But I guess my advice to clients have been, at some point, we don't know how long this is going to go on. So it's about survival. And if you can get this cushion to help you, because we don't know what accounts receivable are going to go bad in the future. We don't know if materials are going to be limited. There's a lot of unknowns out there. So I just felt really good about helping our clients get access to this, because it's just, to help stabilize and help them as the economy hopefully ramps back up in the next little bit. So Matt, anything else on the beginning of the PPP that I didn't, before you take over? He did move, next slide for me. They did move, some interim final regulations issued in April, the beginning of April, that gave us lots of things. One of the big things that came out of that had not been clear and really burned a few clients for us is the fact that guarantee or partner income in a partnership, you just go ahead and add that in your payroll cost up to $100,000 per partner. There is a limit even on employees when you go through that calculation, that you can only use compensation up to $100,000. So that interim final reg kind of clarified that for us, but we're still waiting on additional guidance for forgiveness. We're hoping those will come out this week, but they're also concentrating on getting more money. So we're still waiting, and know we'll learn a lot more about that. But right now, it's, we just have to go on the information and the guidance we have right now. Another problem that we'll mention that is probably helping push along the fact that the money ran out, self-employed individuals are also, this is also available for them, but for whatever reason, they were not allowed to apply until April 10th was the first time they were allowed to apply, and within 3 to 4 days, the money was gone. So that has been a really hot button that, okay, companies got a week head start at the money, and then there wasn't anything left. And to be honest, banks, the smaller the application, banks are really not that interested in doing them. They do get a loan fee of, on the smaller ones, 5% for processing the loan, but then they have this 1% interest rate to collect on. It's kind of been a misconception that banks are having to fund this out of their own capital. They are not getting this money replaced from the Fed immediately once they fund the loan. They will not get, as of right now, they will not get made whole until the forgiveness application is taken care of, and then the bank will get paid the money. So the bank system is having to fund this $349 billion out of their own capital. And that has been a really hot topic as well. that it's been very limited for banks. And that's why you're seeing a lot of PayPal, QuickBooks, Intuit, Square, some of those electronic vendors are coming on board and have been approved so they can help fund probably the smaller ones. So that fintech community is coming on to help alleviate the stress, because we have some banks in our local areas that are maxed out. Like, we can't do anymore because of capital restrictions that they have from regulation. So that's some things to keep in mind. And I see there's some questions popping up, and we'll definitely get to those. But Matt and I have lived PPP for about 2.5, 3 weeks at this point. So I'm very aware of all the things going on with that. And like I said, I'm going to turn it over to him and let him go through some of the steps of forgiveness, so you can kind of get that in mind if you're going to still apply, or if you've already applied, get some ideas on how to track that.
Thank you, Lisa. I appreciate everyone being on the call this morning. Hope everyone is doing well. Like Lisa mentioned, we are really struggling and waiting for some guidance here on the forgiveness portions. The CARES Act, if you actually read the act itself, seemed like it was clear up front, but then when you get down to the nitty-gritty details of some of the provisions that are within the CARES Act for the forgiveness section, it got really hairy in terms of what can be used, what can't be used, how do you go about this FTE requirement, and then we'll also talk about a 25% reduction in wages, what's the time periods, and so a lot of questions have come out for the CARES Act, and so we're going to go over what the CARES Act states, but do remember up front that we are diligently waiting for some new guidance on the forgiveness so that we can certainly pass that information along to you as quickly as possible. That being said, we'll jump right in here. And so there are 3 main provisions or requirements within the CARES Act and the PPP program. The first one, Lisa had mentioned, the 75-25 requirement. I call it the 75-25 rule. So we're going to discuss that one. But then there's also the full-time equivalent, the FTE requirement, that we'll talk about as well. And then the third one there is a 25% reduction in wages requirement. And so when you kind of look at this, you have to apply these 3. And so there's been a lot of webinars who state, well, you should do this one first, and then the next one, and then the following one. It's still kind of up in the air which one they want us to apply first. But the generic consensus is that you would apply the 75-25 rule first to make sure that 75% of the loan proceeds were used on payroll. And then from there, if you've met that 75, you drop down to the 2 remaining ones that actually look into reduction of the forgiveness amount with the FTE requirement and the 25%. And so that's kind of how we see it as now. Like I said, it might be cleared up with some additional guidance, but that's how that is looking so far. So moving right into the 75-25 rule, at least 75% of total forgivable expenses must be spent on payroll. And so I've got a couple examples here that kind of show that requirement in action. And so the one there on your left, the total loan amount of $150,000, the payroll cost of that amount that was used after your 8-week period is up was $120,000. And you can see the other items that were able to be used were rent and utilities there for $10,000 and $20,000 respectively. And so you can see after the percentage breakout that the payroll costs, like I said, that includes wages, health insurance, retirement benefits as well, that is paid on behalf of the employee by the employer, came out to 80%. So you would meet that rule, and then we would then go and look at the other 2 reduction requirements as well. So you can see on the right, the total loan amount was $150,000, but we spent more on rent and utilities and therefore lowered our payroll costs of the loan amount used. And so we did not meet that 75% mark. And so that doesn't mean that the whole entire loan is not forgiven. It just means that now you're only going to be able to begin forgiven the actual payroll costs, not the extra items, the other 25%, you could call it forgiven. So you're reduced back to just the payroll cost because we didn't meet the rule of the 75-25 rule. And then obviously there are things to think about when you're looking at the 75% rule. Like I said, we will talk about this as when we get to the reduction in wages as well. But one thing to note is there has been some guidance stated that you can come and do what's called catch-up bonuses to get you to that mark. And that's something that you maybe as an employer might need to think about, because obviously we want to hit that mark. We want all of our clients to try to hit that mark so that we can get the 100% forgiveness in play for that. And so just keep in mind that we can do these bonuses, but one thing to note is that there is a cap of the $100,000 annualized per employee. And so if we're coming along and we're going to increase everyone across the board, but we have some people already annualized over 100,000, you're not going to want to be able to bonus them because it's not going to count. We won't be able to use those proceeds as part of our payroll costs. And so you would really need to look on this as an employee level per employee, because you're going to have to really kind of dig down into the details to make sure that we can apply it appropriately. But do note there are things we can do to increase payroll to that 75%. We were on a call this morning as well that talked about if you perhaps you as an employer are paying employees biweekly, and when you've got your 8-week funds, you were right in the middle of a pay period. And so maybe when we get to the end, instead of not being able to include the 2-week pay period, we go ahead and do a 1-week payout, because the 8 weeks we have learned is on cash basis. So being expenses that have been incurred and paid to be able to substantiate those expenses. So just keep that in mind in the 75-25 rule. Going to be really important to try to get there if we can, but also note it's not a do this and we can not have it all forgiven. If you don't reach the 75% rule, you're just kind of reduced back to your payroll cost portion of what can be applied for forgiveness. So moving into the second requirement here, the full-time equivalent or FTE requirement. And so we're going to have to calculate this as an employer each week going forward. And so it's based off weekly. We thought we could be monthly. And so we are going to look at certain months, but then you really have to go back and look at your pay periods and your weeks to really dive into what is your actual FTEs. And so I will state right out front that the SBA has come out and stated that a full-time equivalent is anyone who has worked over 30 hours in a week. And so that would be over 60 hours in a 2-week period. And also part-timers, if say 2 part-time employees worked 15 hours a week, they would be considered 1 full-time equivalent. So they did come out and give us some guidance in terms of who can be the FTEs. So we are still waiting on some guidance on how we're going to apply this FTE requirement. So what they're going to require us to do is get an average number of FTEs per month from February 15th, 2019 to June 30th, 2019. And so it's a calculation. And so this is going to be part of the denominator in our calculation. And so you can see at the bottom, the goal is to always be above 1 or at 1 after the calculation. And so at first, you're going to take your average number of FTEs per the 8-week period that we have the loans for. And so let's just use a nice round example of 40. Say we had 40 FTEs, full-time equivalents during our 8-week period that we received the funds from that started. And so then you would have to go look and you have 2 options. Option 1 that we talked about, say that was 42 employees. And so you can see that we're already down 2 FTEs from our 8-week period. We had 40, and last year when we're comparing it to those months, we had 42. And so we're not at that 1 mark. And so you also have the second option, the average number of FTEs per month from January 1st, 2020 to February 29th, 2020. And say for an example, those were right at 39. And so we averaged 40 for our 8-week period, and that option 2 FTEs, when we went back and looked, was 39. And so then we would meet that requirement of the full-time equivalency. And so we would be able to be 100% forgiven to be moved forward. And so then we would go to the second, second requirement of the 25 wage reduction. But just to give you an example, that's some of these calculations that are going to be kind of difficult. And we've created a spreadsheet to kind of help you put your FTEs in perspective for each of the different time periods, because you are going to have to go back and pull some records to see, are they over 30 hours? Do I have some part-time individuals that can get to me to a full-time equivalent? But then there's also things that we need to talk about right now in your 8-week period, if you've received the loan proceeds, to say, okay, maybe I do have some part-time employees right now. Would it be beneficial for me to take those part-time employees that are maybe working 20, 25 hours and go ahead and increase them 5 more hours to get them to that full-time equivalent for this application of the PPP process? And so things to think about, and they're really detailed, but things to think about that we can help get our FTEs up during the 8-week period. And then obviously we're going to have to compare those to those two options there. And just remember, the goal is to be at or above the 1 after the calculation. So moving on, we got some additional guidance last week about this 25 reduction in wage requirement that has really thrown a hurdle for all practitioners, because I'm just going to state up front that the calculation seems a little bit flawed, meaning the act itself states that you're going to take your total payroll cost per employee during your 8-week covered period, and you're going to compare that to the most recent full quarter. And so for anyone who has been funded in April or May, that most recent full quarter that has been completed would be the first quarter in 2020. And so when they set up this rule, one thing we've noted as practitioners is that you're comparing an 8-week period to a 12-week period. And so when you look at the CARES Act, it looks like they had come across and said, well, okay, we're going to cover these 8 weeks. We're going to compare them to 12. So we know there's going to be a reduction in wages. And so that's where they have come back and said, well, the reduction can't be more than 25%. We know there's going to be some reduction because we're comparing 8 weeks to 12. Now, they're thinking in that, and one thing that Lisa and I have struggled with this concept is that you're already going to be at a 33% reduction in wages. Because if you compare 8 to 12, I mean, you're at that 30% reduction mark already. So you would have to do something as an employer, whether it be a catch-up bonus or whether it be an increase in pay over these 8 weeks to get you above that 25% reduction requirement. And so I've got a couple examples here. This is part of our spreadsheet that we put together, and I kind of wanted to just walk through it and give a couple examples here so that you can visualize and see how this would work. So just take employee 1, for example. Their 2019 annual compensation was $65,000. The next column there, excluded due to compensation over $100,000 or reduction is less than 25%. That box is not checked because they are under $100,000. One thing to note while we're moving from left to right on this spreadsheet, like employee 2, their annual compensation was $325,000, so they would automatically be excluded from having to calculate this. That's due to being over that $100,000 annualized limit, and so we would not have to do this calculation for them. But back up to employee 1, you would need to go and find, so these are where your payroll journals are going to come in handy, your year-to-date gross wages earned as of March 31st. And so you can kind of see that time period, but employee 1 earned $10,000 during that first quarter, because that's where we're going to compare our 8-week period to. And then to be able to see the amount earned during your cover period, just simplified calculation, you can use that next column, year-to-date gross wages earned as the date of the loan disbursement. Go ahead and pull that number, and then you can pull the next column's number, which is the year-to-date gross wages earned at the end of the 8-week period. Then you take the difference in those two to get your amount earned during your cover period. And then you come to the column where it talks about the percentage reduction on a look-back period. And so you're going to have to go and look and see what was earned during our 8-week period and compare that to our fourth column, the $10,000 for employee 1. And you can see where we had kind of talked about the calculation being a little flawed is because we're comparing $6,000 earned during our 8 weeks to $10,000 earned in a full quarter. And so that calculation comes out to be a 40% reduction. And so like we mentioned, we're above that 25% limit. And so then we would have to take the difference between the 40% and the 25%. So we were over our allotted 25% by 15%. And you would have to multiply that 15% back to the annual compensation earned in your first quarter of $10,000 to get a reduction amount of $1,500. And so that is a lot of detailed information and a very complicated calculation that's going to have to take place per employee. And you're going to have to go back and look at those numbers, and we're going to have to substantiate the expenses, obviously, to get the $6,000 and the $10,000. And so, but moving from left to right, you can see this is going to take a lot more work than I think they had initially thought when reviewing the CARES Act, to be able to see, okay, am I going to meet this 25% reduction in wages requirement? Just want to show you guys the example on employee 3. 2019 annual compensation was $97,500. He is not excluded due to being under 100,000, but the reason that box is checked is if you work through the calculation to the left, from left to right, you can see that his reduction in wages was only 7% when comparing the amount earned in the 8-week period back to the full quarter. And so that's why that box is checked, that he met that 25% reduction in wage requirement, and so therefore there is no reduction for him. So a lot of complicated calculations, but we do have a spreadsheet that we will be passing along to help you guys calculate this moving forward. So those are kind of the 3 hurdles, we call them, or the 3 requirements that is going to be required for the loan forgiveness. I will just go ahead and mention this, and Lisa can chime in as well, but detailed documentation is going to be important. One thing we do know is that the lenders, the banks, will help with the forgiveness application in terms of getting the application ready, but then they're sending that to the SBA. And so your final forgiveness is coming from the SBA. They're the ones making this decision. And so on the front end, the lenders were required to basically take a certification of faith saying, in good faith, stating that our numbers were correct for the payroll numbers we were using to be able to come up with our loan amount, where on the back end, in the forgiveness, it's going to be a really detailed, documented application that's going to be needed. And so just want to make sure I mention that. We can help you with the documentation needed. Basically, for instance, for payroll journals are going to be acceptable. But then when you get into your rent and utilities and things of that nature, they're going to need copies of like a canceled check and an invoice, things of that nature. So just be looking out for those and making sure we're doing this as we go. I would recommend also, we do this kind of on a week-to-week basis. And so we've actually geared our spreadsheet to look at expenses paid over each week in the 8-week period. That way you're not getting to the end of the 8 weeks and realize that I need to go back and pull a lot of substantial documentation to get in for my loan forgiveness application. So a lot of detailed stuff, but Lisa, is there anything else you would like to add?
I might mention that I know some banks and different things, you're hearing it on TV and in the media, that maybe you want to take this loan forgiveness money and put it in a separate checking account to track it easier. That is not required, but if you feel like that would make life easier, we have had clients that are doing it both ways. If you have a good accounting system, as long as we can substantiate the cost during that period, it's not a problem. But some people are putting that money in a separate account just to make it easier to track. So that's kind of one way to think about it. And what I would say about this very complicated calculation that Matt just went over is there's really been a lot of discussion about, okay, are we reducing this two different ways, but it's really the same calculation. So, you know, if you're reducing it because the number of FTEs has fallen over the 8 weeks compared to one of the comparison periods, well then, you know, you're working people less hours, different things. When you come over here and calculate the 25% reduction in wages, aren't you basically in some format calculating a reduction twice and they both can reduce your forgiveness? So that doesn't seem clear to us, and that's why we're really hoping to get a lot more guidance on that. And I know the AICPA on our behalf is lobbying hard for that, because a lot of the FAQs that have and guidance that has come out after the fact is they have went back to Congress, and Congress has always, or the Senate, and they have always said that was not our intent, right? So they're rushing to pass things with good intentions, and then it gets in, the devil is in the details, and all these questions come up, and they're having to kind of go back and say, well, that wasn't the intention. And so we have been getting some good clarifications and guidance after the fact to try to help that. And so hopefully now that us number people have our hands on these calculations, we can go back and like, this doesn't make sense, because it just doesn't really seem right in how they're calculating this, but that's what we have right now.
I believe that was the last slide, Lisa. And so
Okay.
we do appreciate everyone being on the call, and we do have a few questions here. So if you have any that have come up during our presentation, feel free to go ahead and put those in the chat feature now, and we can go ahead and start answering those. But Lisa, I'll just kind of read out maybe them out loud, and we can take turns answering as we go. So first question there, for employers, when does the 8-week time period begin for their PPP funding? And so I would just go ahead and state that that is as soon as you receive the funds. So the first disbursement of those proceeds to your account is when your 8-week period will start.
And Matt, I would add to that, because you have to watch, because I had this happen on a client last week. I think it's defined as loan origination date, which all of us think that's when we get the money. But I had a client last week who didn't get their money till 2 or 3 days after the origination date. So you really need to watch the date on the paperwork you're signing, because I had a client who was 2 or 3 days different. So just watch that.
Very good point. Very good point. It says, another question, additionally, if they are mandated closed, I'm assuming businesses have been mandated closed, how do they expend the federal relief funds? And I know you've had a couple clients that you've had to have that conversation with as well, Lisa.
Yeah, and it's really going to make it hard. And I think our lobby groups are really pushing. I think restaurant lobby groups are really pushing for them to come out with some kind of caveat for this, because if you don't spend the money, you've got to pay it back. So if you can't be open, you can't spend the money. So I think there is a lot of pressure for businesses that are mandated to be closed, that their 8-week period really not start when they get the money. Now, as it stands right now, that's not the case. So, it's really a toss-up how you handle that. I have some clients that they can't open, so they have really left their workers on unemployment for now. And once they open, then they'll spend it. They just know that it's not all going to be forgiven, but they have the money and the safety net if they need it. But yeah, it's a real problem if you can't be open, that you're not going to be able to spend the money. It's going to be very, very hard. So what I've just told clients is, that's a good case. Have it in a separate checking account, pull on it when you're spending the money, but chances are, if you're not going to spend it all, it's not all going to be forgiven, and you're going to have a loan for the next 2 years that you're going to have to pay back with a little bit of interest. But again, that was kind of one of these things, first come, first serve. So if you don't get your name in the pot to get the money and it's gone, then you don't even have the options of spending it or not. And I think that was something that drove a lot of people to apply. Just, there's so much uncertainty, nobody knows. But I think there is a lot of pressure to change that 8-week period if you can't be open, and we'll see if anything comes of that. As hard as it might be, there's also the ability to take your employees off of unemployment and pay them anyway, to get the forgiveness amount. You may pay them not to come in, which seems to be some DOL type issues, but that is some of the guidance out there as well. Because I guess the way to look at it, the government's paying for it one way or the other. The government's funding the unemployment, or they're funding this program for you to pay them. But yeah, it's a real struggle if you're not open, how you're going to do that. And I think most of the clients I've talked to have just said, well, I'm not going to bring them back until I can. And I just realized that it's not going to be all forgivable.
Next question here, is there a separate application for the payroll tax credits, or do you just calculate on Form 941?
Yeah, it just goes on the 941. You can, to get an advance, if you don't want to wait that long, or you have more money to get back. As I mentioned, you can do that Form 7200. So we're still waiting to see what the new 941 is going to look like. I have not seen that yet, but my understanding is down at the bottom where it has total deposits, there will be a new line for credits, and it'll just go there.
Next question, do nonprofits qualify for the retention credit?
Yes, they most certainly do, and they are also eligible. We did the PPP program for several nonprofits and also churches. So people hear churches and they think they're nonprofits, but technically they are not categorized as a nonprofit from IRS standards. And I know Matt worked on several of those. And Matt, you might talk about some of the nuances we ran into with that, but churches absolutely can do that too, because until this last change, church employees couldn't file for unemployment because churches don't pay unemployment. So I think there was a lot of pressure to make sure churches had the ability to get some of the relief.
No, I would agree. I think in terms of documentation that were needed for the PPP loan for a church, it was a little bit more substantial, just making sure that everything was in line in terms of documentation for people who are maybe the treasurer, and things of who has to sign what was kind of a big hurdle for some churches. But other than that, churches do qualify. And so they just need to make sure that they have the necessary documents and then kind of walk through the steps of the application, but they as well can get funded. And we've had a few actually that have gotten funded as well. Next question here. Are there loans available for farmers who file Schedule Fs? The loan was from Stated Agriculture, was exempt from loans, and then talked about the lowering of prices for cattle.
So we have filed one application for a farmer, but he has payroll that we could use. One of the big things to consider there is, it can't be the H-2A workers. One of the caveats of the employees that their principal place of residence has to be in the U.S. We have a lot of farmers or a lot of construction that utilize the H-2A or H-2B programs. So that payroll for those employees does not count. There's been I have not seen, all the guidance says take your Schedule C as a sole proprietor. The net profit is what counts as the payroll for the owner. I don't see why Schedule F would be any different, but I don't know that I've ever seen them refer to Schedule F in any of the guidance. I've read a few articles also where the USDA is really pushing that it shouldn't be based off of net profit for farmers, but I've not seen any further clarification on that at this point. Matt, I don't know if you have.
I have not. I was thinking back during the FAQs that we've kind of gone through, and I don't think they were mentioned Schedule Fs, but I would agree with you as well that it would seem to be the same process as the Schedule C. But no, we have not received any additional guidance on that. Another question here that just came in. So first question, are PPP loans still going to be forgiving if employees won't return to work due to making more on unemployment than of actual work due to the $600 increase in the unemployment checks?
So it as of right now, it's just going to fall back on that calculation. So if they will not come back and you have no one to pay to meet those rules of the, your FTEs being back to where they need to be and the reduction in wages, as it sits right now, I think that, you will have a reduction in your forgiveness amount. I think that's the thing we're really waiting for some guidance on. But, Matt and I have talked a lot over the last couple of weeks that this roughly $1,000 that people are getting to be on unemployment right now is such a big number to overcome. The problem with it is that's a national number. So, $1,000 in Kentucky per week is a huge number, but $1,000 in New York City is not. But when they came out with that $600 supplement from the federal side, they had to do it nationwide. It's really causing some concern. I think that unemployment is only good through the end of July, so it does definitely have a finite life. So if people value their jobs, you would hope they would come back, but I know that's not going to be the case all the time. But Yeah, if you don't spend the money and you don't have your FTEs back up to those comparison periods, it's not all going to be forgivable. Matt, did I cover all that right?
Yeah, no, the money has to be spent. And one thing I would just note, we've had a couple clients that have actually realized that unemployment dilemma there and have actually increased maybe the wages that they are paying to employees and almost call it like a COVID-19 pay that they were going to get paid for the next 8 weeks due to wanting to get their workforce back in the building and back to work, but realizing that the employee has a hard decision because they're making more on unemployment than if they were to come back. And so, and that kind of goes hand in hand with that client we had that conversation with. They wanted to make sure they got to that 75% of their loan being for payroll. And so they did. They went ahead and increased, I think it was almost a $5 increase per hour just for these 8 weeks to be able to help them get to the 75% as well as to keep their workforce intact.
Well, and they were recognizing the fact, I think that was a construction client, and recognizing the fact that, going to sites that maybe they, if you have a federal job, sometimes you're getting paid different, that maybe if you're putting employees a little bit more at risk, that it warrants the extra pay for right now.
Correct. I think we've kind of covered the second part of that question. The money just has to be spent. So the second question is, are PPP loans still going to be forgiven if employees are unable to return to work due to being a high-risk individual who would be at a greater risk or death if they contracted COVID-19?
Yeah, and I would just advise you that we've had to deal with that with some people, and you just really have to make sure you're documenting that right and getting the proper doctor, physician backup in your file for some of that, because you should, if that's the case, you should be available to some of the credits we talked at the beginning. Well, we filled the hour, Matt.
We did. Appreciate everyone tuning in this morning. Really do. I know there'll be a lot of more information, and like I said, Lisa had mentioned earlier on in the webinar here that we will have another one this Friday. So be looking out for that, and we're hoping that some new guidance on the forgiveness portion comes out, that we can provide that information to you all as soon as we get that.
Yeah, if you need any help, feel free to contact either one of us, Susan Ross in the Maysville office, as well as Tim Eldridge in Flemingsburg. Reach out. We're all staying very apprised of everything and glad to help you or answer any detailed questions you have that you didn't feel comfortable asking today. So we appreciate the Chamber giving us this opportunity and hope everyone found it helpful, and have a great week.
Take care, everyone.